Hi there, my name's George and I'm a chartered financial planner. And in this episode, I'm going to be answering the question, should some famous TV characters have taken financial advice? So I'm going to be going over Friends, Breaking Bad, to Sex and the City and answering the questions of what would a qualified financial planner suggest they look at? So before I start, one caveat I'm going to have to throw in is we're going to have to assume these characters have the same story but are based in the UK, because of course I'm a UK-based financial advisor. So bear that in mind, and the tax position, some of the rules will differ depending on what country you're watching it in. I'm also going to pick certain bits instead of doing a full financial overview for that person, but if you do want to see me do a full financial review on a character, put that in the comments and I'll see what I can do. Okay, so here we go. My first meeting is with Ross.
23 years and never have I had so much business from one client.
Right. Ross, if I'm being honest, I could have done a whole episode on him alone because that guy has some serious planning needs. But let's go over some of the easy ones. Ross has spent most of the series with Ben, his son, and towards the end with Emma, which means in the UK, for the vast majority of the series, he would have potentially been entitled to child benefit. And so we don't go down a rabbit hole, I'm going to assume that it's Ross getting the child benefit instead of going to Rachel or Carol. But anyway, according to ERI's... This is so stupid. According to ERI's salary expert database, the average paleontologist salary was £46,793 per year, with a more senior salary being up to £58,000. And that means that there's one thing on my mind, and it's not just why does Ben disappear entirely after Series 8? Anyway, it's are we making the most of child benefit? So let me explain. Child benefit is a UK benefit, shockingly, if you have kids. But there are some caveats. Now, what you get currently is a higher rate for an eldest child of £21.80 a week, or a low rate for each additional child of £14.45 a week. So how that works is that if adjusted net income, and that phrase is important, and I'm going to come back to it, is between £50,000 and £60,000, then what happens is there's a tax charge applied. And how that works out is that if you have adjusted net income over £60,000, the amount of the charge is the same as the child benefit you would have received. So that means the benefit disappears. So the potential benefit for 2 kids for child benefit is £1,885 per year. So you might be going, okay, well, what's the planning opportunity here? Well, depending on how senior Ross is, and I'm going to assume he's doing okay, we're going to say he's earning £58,000 per year. So in this instance, his income is £8,000 over the £50,000 limit, which means he'll face a tax charge of 80% of £1,885, which is £1,508. which will effectively remove 80% of the child benefit. So what could I do? Go back to that adjusted net income, and that basically is total taxable income before any personal allowances and less things like gift aid. But the thing is, we can use a strategic pension contribution because they are tax relievable to get down his total taxable income to £50,000 or under, which has the benefit of not only increasing his pension contributions that he makes, but it also interacts with the rules of child benefit so that he can keep his full child benefit. What? So anyway, by advising him to contribute £6,400, he's saved £1,508, which was the reduction to his child benefit. But there is more. Because it's a pension contribution and quite a large amount lies in the higher rate income tax band, he'll also be able to claim an additional £1,546 in tax relief through his tax return. So he's got an £8,000 pension contribution that's in fact cost him £3,346. And there's the working there. That's not a bad start, but what's next on the planning agenda for Ross? Well, what did you think?
Hey, divorced men are not bad men.
They have that on the napkins at the club.
Okay, so as we know, Ross had lots of divorces. And in England and Wales, the total value of the pensions each individual in a marriage has built up is taken normally into account. And this doesn't only mean the pensions that you or an ex-partner have built up while you're married or in a civil partnership, but potentially all of your pensions except the basic state pension. So divorcing is a big financial event.
I mean, if you're not careful, you may not get married at all this year.
And if you end up going to court, they'll try and achieve fairness. So generally as a starting point is 50-50 split, but it can of course be adjusted if that doesn't achieve a fair result. So one of the things I'd be doing is I'd be having a chat with Ross about this and his pensions, because there's a chance that his pensions could be considered as part of the divorce settlement and given to an ex-spouse, you know, Caroline or Rachel. So anyway, option 1 is offsetting. And under offsetting, the value of any pension is offset, as the name suggests, against other assets. So you keep your pension, and in return, your ex-partner would receive a greater share of the other assets. The pension benefits are valued as a lump sum in today's terms. Anyway, offsetting isn't possible if there aren't enough pension assets, obviously. Option 2, though, is an attachment order. And a pension attachment order, which is often called earmarking, works by allowing the partner without the pension to receive the income or the lump sum payment from it in the future. So the pension benefits are said to be earmarked for their benefit. And there are quite a lot of conditions that surround it. And there are quite a few challenges around this, because one of the problems is it doesn't really achieve a clean break. And sometimes it can be the case that the benefits don't get put into payment until the ex-spouse chooses to do so. So sometimes it's not considered ideal. All right, option 3 is pension sharing. So pension sharing works by splitting the pension benefits at the time of the divorce. So how this works, however it's split, is that the partner without the pension receives a share of the pension benefits which are transferred into their name. The partner gains the pension benefits and gets what's called a pension credit. And the partner who loses the pension benefits, like Ross, gets a pension debit. So pension sharing is often considered the preferential route because it creates a bit more of a clean break. Both Ross or whichever of his 3 partners will know at the time of the divorce how much pension they will receive and keep, and death or remarriage for either of them has no effect on the sharing order, which clearly is a big consideration for the likes of Carol. So anyway, just before I unpack this clip, why not subscribe to the channel? Come on, if I'm doing an episode this ridiculous, you kind of know it's worth it. Okay, so next person coming into the office is Walter White. So we know that in Breaking Bad, Walter White is diagnosed with cancer and faced with the prospect of escalating medical bills, and decides to start making meth, and all sorts of fun follows. Anyway, the big difference here, I guess, from the US to the UK is that in the UK we thankfully have the NHS, the National Health Service, so people don't generally go bankrupt due to medical bills for that type of illness as much as they might in the US. But could Walt have done more? Well, yeah, actually, even if it'd been the UK. Because I think we're all getting more aware of this, but just because we have the NHS in the UK doesn't mean that the state will provide as much as you'd like. In fact, there was an FT article which came out saying that Britons pay almost as much as US citizens out of pocket in some healthcare expenses now. So the good advice here probably would have ruined one of the best shows on TV for a long time. But let's say a good financial planner had sat down with Walter White while he was a teacher still. They'd say, firstly, let's check if your employer offers any sort of sick pay or maybe protection for your income. If not, then there needs to be a serious conversation saying, look, your family's reliant on you, and your health and your ability to continue to get up and go to work underpins everything about your finances. So you need to consider the 3 pillars of protection. I've mentioned this in this video, which you should watch. So the first is income protection, and this pays out a long-term income to replace your earnings, as the name suggests. Normally the amount of cover is maxed to about 65% of pre-tax earnings, and this basically means because it's tax-free when it pays out, the step down actually isn't that much when it happens. The reason why income protection is so magic and why everyone should have it, that's not me saying that, that's Which saying that, is that once you've done what's called underwriting, where the insurer is understandably going to want to know if you have previous health issues and so forth before offering you the terms. As long as you get through that and there's no exclusions, anything that signs you off work from a doctor is going to be covered. So as long as you underwrite it fully and understand the terms, you're potentially covered whether you have, a back injury, cancers, all sorts of things. And it just gives you that protection, which is so crucial because none of us know what's around the corner. The reason I think that for financial planners it's important we have these difficult conversations is because most people's answer is, what happens if I was too ill to work? And it's basically normally a long pause and I'd be screwed.
Also not a very good plan. What else you got?
And the thing is, all the more fun things with personal finance, the investing returns and all the rest of it, it's sort of a total waste of time if you don't build in that safety net. But anyway, rant over. Pillar 2 is critical illness, and it's designed to pay out a lump sum on diagnosis of a critical illness. And this is a bit different because it generally is set up to give you a bit of financial freedom if you get diagnosed with a serious illness. So you remember when Walter got his diagnosis, that might have meant that he could have got funding from an experimental but private treatment, maybe adaptations to the home if he became too ill, or just perhaps some financial headroom so that he could go, right, I'm not going to work, I'm just going to focus on my recovery. And sometimes it's considered like an add-on to income protection, but it does potentially fill different needs, because income protection is just going to cover a percentage of your earnings, and it's probably not going to put you in a better position, and it's not going to provide a lump sum. So if you want to take a break from work should that happen, then ideally a level of critical illness is going to be important. And finally, obviously, life insurance, which is designed to pay out and support your family if you die. If anyone is dependent on you, you should have this. In fact, why don't you just watch my episode on the hole in your financial plan where I go over all of it? And there probably is, with Walter, I'd probably be sitting him down and saying, look, there's going to be an amount of cover that isn't going to be affordable because you're a teacher, and that's fine. We can't always get the optimal amount of cover. But the point is, if we have a discussion on it and settle on a level which is affordable, when misfortune strikes, some cover is better than none. So let's say I've just ruined the entire series of Breaking Bad. But let's say Walter came to me after he'd been diagnosed and he wasn't insurable. It is crucial that he puts in place a power of attorney, an essential document for those with a family that most people don't have. Alright, there are two types of lasting power of attorney. One is property and financial, and two is health and welfare. Each, as the name suggests, covers different aspects, one financial and one health decisions. If you don't have this in place, it's very possible, if health deteriorates and Walter loses his capacity to make decisions, it is possible that banks could freeze accounts, not because of copious money laundering like it would be perhaps in this instance, but just because understandably they're going to be concerned that somebody's lost capacity and they don't want any changes to the bank account in that period. And just because they're going to be concerned, so that if there are any withdrawals while that person's lost capacity, that they could be considered to blame. The problem is with this is it is a terrible position for the family to be put in, unable to access the finances to keep things moving or maybe even make health decisions. And the next step, if you don't have this place, is what's called the court of protection, which could take 4 to 6 months to go through and also have additional expenses. Now, powers of attorney you can do from the government website, you can do it via solicitors. It's about £90 for each of them, but I warn you, the forms do need to be signed in the right order and get professional advice if you're not sure. So I didn't realise quite how long this episode was going to be, so what I've done is I'm going to cut this into 2 episodes and I'm going to come back to some bits and whatever, and you can catch the next one this time next week. If you enjoyed it, comment below. This has been Principal's Personal Finance with a truly ridiculous episode. Thanks for watching.